If you need to screw down the model that bad to generate the return, and that's something an investor should look at, then walk away. If you're betting on a back-ended return and you don't get anything, you're screwed. In addition to the forgiveness of debt and the phantom income and the recapture of depreciation and having no cash to pay the taxes with. One thing that I'm looking for is buildings that have lots of existing power that's being used. If I have 15 or 20 megawatts that's there, someone's going to pay me for the power because they need to move it down the grid for a data center that needs 50 megawatts.
So, Irwin, what do you learn in all the years after $5 billion in deal flow? What is the biggest, most important thing that you think you've learned over all those years?
It's the same for in a lot of businesses. Don't get involved with things that you don't know or you can't see. And it's really simple. There's certain things in commercial real estate that like what's rented today, what's your income today, and if you're happy with that, and let's just say that nothing else ever happens, but you can continue to move that with nominal increases, 3-4% a year, compounding with the lease increases, and you're happy with that, that's your downside, and that's a good start. But if you're one of these guys that has to be able to triple your money on every transaction and you're willing to go in with no cash flow, you either have to have very deep pockets or be willing to take very big risks. And along the way, I've worked with people that have done both. And, it goes back to that old saying that the tortoise always beats the hare. So, steady as she goes, bet on the cash flow, you'll create the wealth slowly, you'll have more control over your life, and, and you won't lose your hair. So,
I love it. And I love that you said that. Invest in things you know, like, and understand. And, I've made a whole career out of it, as you have. I know, you're in industrial real estate, and it's relatively boring if you really think about it, but boring is good, right? The tortoise versus the hare. But what would you say is the reason why so many people are playing the Babe Ruth method, right? They're swinging for the fences every single deal, trying to hit home. I know people are just trying to get rich, but in trying to get rich fast, they're getting poor slow or poor fast in some cases, but they just never, you're just always treading water, where what you've done, focusing on just the cash flow in what most would maybe say is sort of a boring kind of sector of real estate, but you've done well. Like, why are people not seeing that? Not seeing that the best path is the cash flow, slow build path versus the swinging for the fence?
Well, I think you have two types of investors. You have the people that are investing on behalf of themselves, and they have a big tolerance for risk, and they have deep pockets. And some people have that go big or go home. But if you look at the marketing that's out there by syndicators looking to raise capital, they portray it. They show you, Donald Trump or Warren Buffett or a bunch of other guys that have made lots of money over the years. And they say, well, this is what you have to do. And they hype up a projected internal rate of return. In 3 to 5 years, you're going to get a 28 IRR, 2.6 multiple. But we're not going to get any, but if you read the fine print and you really look into it, there's no cash flow. You're betting on really a rocket trajectory that's going to give you all that wealth on the back end. You may not see anything all along the way. And I think people don't do enough due diligence. If you look at what happened in this country with real estate, I guess 2010, 11, 12, if you put money in real estate, everybody won coming out of that last, recession, as we call it. And I think that a lot of investors, as they kept making money every couple of years, because the cash flow was there, they kept doubling their money, even though there was no cash flow, they sort of got lazy on their due diligence. Oh, I can't lose. I walk on water. These real estate deals are great. I think everybody got sloppy. And what happened was, as interest rates moved up, insurance doubled and tripled because of natural disasters. That's cyclical, where insurance comes up and down, and payroll costs went up. And then, some tariffs and a little COVID, where you couldn't get your materials. It was sort of the perfect storm to sink a boat. And that's why I think people lost a lot of money. But people were hyped up at how much wealth they're going to create investing in real estate. Now, I'll agree that apartments, everybody, it's something you can't do virtually online. You need a physical place to put your head. So apartments are always going to be a good investment. I don't think you're going to lose your money, but I also think that where we are now, I'm seeing a lot of markets rents decline. People can't continue to pay, 50, 60% of their take home income for rent. And when you look at the deals that are being advertised, and trust me, we look at multifamily every day. We'd love to do it because of the depreciation that's involved there. But I don't think there's anything as a value add deal left. Everything's been renovated 3, 4 times in the last 15 or 20 years. So what are you doing? Where I believe that by investing in the cash flow, which is boring, and maybe that's why people sort of look at me. It's like it's not very sexy. I need a sexy investment because that's my personality. But if I said to you, take your body weight, compound at 3% a year for the next 7 or 10 years, how fat did you get? And then people think about it, they're like, yeah, I got really fat. So that's how I know the value's there. That's just contractual rents. So it's about picking the right building where you can keep it full.
I love that. I mean, listen, like going back to the syndications, I've been doing this a long time as you have. And, when I can think back to all the syndication deals that I've seen, and it's too many of them. And I've invested in one. That's it, one. And I didn't even invest in the syndication. I invested in the person because I believed in them. But that was the only one. And out of all the ones I've seen, I bet you 90% of them, they all were sold with prefs, 7, 8 pref. And
sure.
Then, like you mentioned, this big multiple on exit. And here's what's really happened. Most all of them, about 90% of them have frozen their prefs. Many of them have had capital calls because they ran out of cash. And the exit that they were supposed to have has come and gone because they're locked up. There's no liquidity. Liquidity is dried up in the marketplace, especially for that sector. And I think like really when I look at multifamily, and I agree with you, like it's a great asset to have because listen, everybody needs a place to put their head. But like you mentioned, where's the value in multifamily right now? It's a really hard proposition to wrap your head around when you're doing due diligence on multifamily. I like you, I just don't see the value there. I truly can't articulate the numbers and I don't think that the prices are going to continue to appreciate. I mean, you mentioned something that very few people mention. I did 2 YouTube videos on this now about the declining rents and the big disconnect between the supply and demand. I had somebody beating me up on social media just this morning on one of my posts. And they're like, you are completely wrong and this and that. I'm like, sir, I was super nice and I'm never nice. I'm from New York. I'm usually just a complete asshole. But I was super nice to this person. I said, sir, you are completely incorrect and you do not understand economics. I said, you are mentioning supply demand, but you don't understand the relationship between supply and demand. You are talking about the demand for a product that really doesn't exist in the marketplace today. And then you're talking about demand, which fully exists, but the demand that exists doesn't meet the supply that exists doesn't meet the demand that's out there. So you have this complete disconnect right now between supply and demand. So it doesn't matter how much demand you have. The demand can't afford the stock, the supply. So until the supply reprices, and that means rents come down and price of properties come down, the demand doesn't mean anything. And, I haven't heard back from, but like, that's really the story. In the Sun Belt states, we'll talk Florida, Texas, you are seeing double-digit vacancy rates right now. Well, I bet you any money, all these multifamilies, I bet you they ran their pro forma rates at 3-4%. They're double digits now. Sorry, I don't care who you are. I don't care how deep your pockets are. It doesn't take long before your pockets aren't deep anymore when you're running that kind of vacancy. Plus, you got liquidity freezes. You can't really get the refis. So depending on where you came in the game, and many of these people that bought these multifamilies, they got them in these really, really cheap period of time, the cheap money period, I like to call it, where they were locked at let's say a 5% or under rate, but they had a 5%.
And coupled with that, they was an interest-only loan, so they weren't building any equity through amortization because then you couldn't, hype up the amount of cash flow that you were going to generate.
Absolutely. You had to show a pretty pro forma, right? For
sure.
Your investors.
Amortization is your friend. It helps build the back end. We try to avoid full-term interest only, even though the banks, especially the Wall Street guys love that. Oh, we'll give you 10 years interest only. I said, no, give me 3 years interest only. Then let me amortize on a 30. I don't care. I'd rather have the amortization. If you need to screw down the model that bad to generate the return, and that's something an investor should look at, then walk away.
That's a key thing. So last night I did a 2-hour meeting with one of our internal groups for Private Money Club. And that was the big thing. I just said, why is it so difficult for you folks to walk away? I'm like, I have a very stringent buy list, right? And if everything doesn't get checked, it's easy for me to just say, F you, like I just walk away. Like it's just a business transaction, but like these people are in bad deals. They're losing money. They're not getting their interest. And I ask them simple questions, did you do this? Did you do this? No, I just believed in them. I just thought I trusted them. And I'm like, wow. Is FOMO that strong? And I guess it really is.
No, it is. People sometimes think that especially if you're in a room with other investors, that you have to make a decision. I was at a family office conference 10 days ago, and I got invited to speak before an investor group. There are a couple of these big national investor groups, and they share their due diligence and they share their deal flows and the people that they talk to. Most people get before these groups to sell them a deal. I just want to tell them why, what I do. Again, I've spoken before them, and why I think you need to be careful of certain asset classes, and why I'm like, shallow bay and multi-tenant industrial. And they thought it was very refreshing, that you weren't trying to sell them or shake them down, as some people would prefer it. And it was eye-opening on another asset class and why it's a safer investment. And it's a boring investment, but why I think you're going to do well with it. I love getting those distribution checks every month, and some deals are every quarter, because I can take that money and I can reinvest it somewhere else. Whereas if you're betting on a back-ended return and you don't get anything, you're screwed.
Yep.
Not in addition to the forgiveness of debt and the phantom income and the recapture of depreciation and having the cash to pay the taxes with.
Yeah, that is an argument. I mean, listen, I know a lot of people that invest in real estate deals, and they do it solely for the tax deductions, the cost segs. They don't really care so much about what the return is. Well, they care, but it's a secondary, because the way they look at it is they say, listen, if we do a cost seg next year, that cost seg gives me, this much, in money that I can write off. That's like me getting a 40% return on my money, because I would have given 40% to taxes and now I don't have to. So it's really the same thing. It's just money I don't have to pay to the government that I kept because I bought this asset. So, but there's such, the percentage of those investors is so small that, the majority of the investors can't operate under that pretense or that method, because it just doesn't make sense. They need cash flow. But then right now, the big thing I'm seeing, and I'm front row, I got a front row seat to this whole charade. I'm seeing people not getting the cash flow that they thought they were. These people invested their self-directed IRAs. They went all in on these deals, and now they got no cash flow. So they got to get jobs again. I mean, it's a really sad period of time right now. And we're not even in a recession. We're just in this lockup period of time, this weird cycle. And, I don't know when we're going to come out of it. But for like what you were saying, if you just invest for cash flow. Now, I want to put a pin in that, and I want to just segue real quick. You're in industrial. Can you just talk a little bit about like industrial? Because like most people, when I say that, they got a vision of industrial, but just explain like what it is you invest in and why it's so good for cash flow.
Sure. Industrial is a big catch-all term. It's everything from, a 1 million square foot Amazon distribution facility to a cross-dock truck facility where you might have, a third-party logistics guy shipping goods all over the country for different manufacturers, to an actual manufacturing plant that might, think of General Mills, General Motors, Ford, Hyundai, those are industrial buildings, to, people in the defense world like General Dynamics, the First Data that does credit card imprinting. And then, so you have those buildings, and they're all different vintages. They're all over the country. And then you have, sort of like what we call shallow bay, which is a little bit older product. It might ultimately be a maximum of 20 or 24 feet high, and you might have tenants as small as 3,000 feet going up to 25,000 feet. And, that's sort of the multifamily of the industrial world, because you could have 500,000 square feet. The deal we closed in February was 500,000 square feet and 5 buildings with 48 tenants. So they're all different sizes, they're all different uses. Everything from compounding pharmacies to nuclear pharmacies to defense contractors, where I didn't have security clearance to walk in the building, to uh, uh, radiology groups, to doctors' offices, to architects. So sort of hodgepodge people that's like that. And the beauty of the flex or the shallow bay is that your office is typically in the front, and then the party is in the back. Where you have either distribution or equipment, and you have either dock high doors where trucks can back up to it, or you can drive your vehicle into it. And the small shallow bay flex buildings are in everybody's neighborhood. You drive by them. Think of the body shop, the plumber, the electrician, the guy who does your sheetrock, a carpenter. They all have a little space of office in the front where someone orders the materials and books the appointments and collects the money and does the bookkeeping. And then they have their shop area. And then they have areas where they drive the vans in and load them up and go out to people's homes to fix things. And those could be really small, maybe 5 or 10,000 square foot buildings of 1 or 2 tenants, up to very large facilities. And it's mind-boggling. So, originally I started in the multifamily world, working for a very large owner-operator, 30 some odd years ago. And when I got involved with this asset class, I'm like, what is it? And then you sort of see it. And as you drive around, even on vacations or travel, you see these things and you get to learn a lot about what goes on and what drives certain parts of the states.
Yeah, no, I mean, it is funny because as you're talking about that, I'm like, yeah, driving anywhere, you drive by a dozen of these type of buildings or more.
Correct.
Everywhere, but you never really think of them, But then when you drive by one of these brand new multifamily apartment complexes that just went up, you look at it and you're like, wow, right? But
Right.
I drove by 10 of these industrial buildings and I didn't think a single thing about any of them, but I'm wowing this apartment complex that just went up down the road. So you're stepping over nickels to pick up pennies is another way of saying it.
That's exactly right. Especially, to invest in an apartment building where I have to worry about insurance costs doubling or tripling, or hiring the right staff. People that work for you want to be able to make more money every year. The utilities go up. And so everything that it's involved in operating an apartment complex is on ownership. You can't pass through operating expenses to the tenant. Yeah, we figured out over the years, everything is separately metered for water, for gas, for electric. Maybe we're charging them a fee to have a pet. Maybe we're charging them valet trash. Leave your trash outside the door. We'll pick it up. We're trying to make money on the internet, the telephone, and everything else. But the bottom line is, if you have a 300 unit apartment building, you probably have 500 toilets in there that could clog up, and 400 air conditioning units that might have to go. And you just, and think of all the stoves and dishwashers, and it just adds up after a while.
Sure does. Now, when I look at your track history and everything, you've done a lot of different things. I mean, you've been the direct lender, you've been the advisor, you've served as the investment banker. So you've done all different aspects of real estate in this capacity. Like, which one was your favorite?
Well, I think that working as for owners, you learn a lot on the operation side, and you get to see how they make their investment decisions. A lot of it is based on operating the properties, and so they sort of have their own philosophy. Well, I like this kind of property and not that one because here's our experience with it. Here's certain tenants we don't want in our building, and then working as a lender, you get to hear all the stories. And you get to see what investors try to, a borrower wants to sell you and see if you swallow it. And so I'd like to think over, all these years, I've heard all the stories, all the good, all the bad. And even to this day, there's sometimes people start saying things and I got to leave the room because I don't want to be in the same room with you because I know you're full of crap. And you're just like a train waiting to go off the tracks, and people should not invest with you. And that's really a big part of what I've learned over the years. But being a lender was great when interest rates were low and capital was available. You could lend on almost anything. But still, the value add part, if we were betting on a future, we were providing a bridge loan. We wanted to know how we were getting out before we closed the loan getting in. And so we were one of the more conservative lenders out there. So there's a lot of loans that we lost to other people, and all right, in the right environment, when all the values are going up, everybody gets out. But when the music stops, you can't find a chair to sit down, and so we watched a lot of those guys have some bad loans, years down the road. Uh, I also spent some time in my years doing construction lending on multifamily and some other types of assets. And there, it was in a good environment. You knew what the lease up was going to be, and people were building to pretty good, 7 or 8% yield on cost. Where now, I looked at one yesterday with one of my groups, and I said, it doesn't pay to build it. I said, if someone wants to give you $10 million for the land, your basis is pennies. You've owned it all these years. Sell the land, because to take the construction risk to build on a 4.5 or 5% unleveraged yield for maybe a 15 IRR 5 or 7 years down the road, it's not worth the risk.
Not even
And
close.
it took them a little while, and they're a very conservative group. And they said, we're right. You're right. It's the construction costs of what it costs to build now. In some of these things. And even when we buy industrial, I want to buy below replacement cost. I know what it costs to build. And then I'm looking for brick, or what we call concrete tilt-up panels. I'm not buying, like in some parts of the country, you see all these looks like corrugated metal. Those things blow away in the wind. They're great when the weather's good, but you get a good twister to come through, and those things are gone. So that's not for me. I like to know my buildings are going to be there, barring some extreme natural disaster.
Yeah, we're getting a lot of them. I mean, it hasn't really been in the news, but my wife sent me over an article about what's going on the West Coast, Oregon, Washington. Man, that is
Yeah, the
bad.
rain they're getting there, and they don't usually see that rain. Where Northern California is getting, up by San Francisco, up there is getting hammered with rain.
Yeah.
And unfortunately, they have no way in California to capture any of this when they have droughts. So it just runs off and goes out to the Pacific. But I think you're going to see some record snowfalls through the Sierra Nevadas and up in the Rockies because of it, if it's cold enough. And then the storm that came up from the coast up to the Northeast here, dropped a lot of rain, although now it's sunny outside. But now the wind's going to shift to come out of the north. So hopefully it dries before it freezes.
Yeah, I don't know. That's what we're getting, because I'm up here upstate New York. So we're getting that wind now and that rain, which is turning to sleet and snow. So I think we're just going to go right from the little warm up right back to the deep freeze, or at least it seems that's the direction we're going.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
But also, depending where you are, upstate, you get a lot of that lake snow effect. So
It's been an awesome winter. I'm a big snowboarder. I used to be a pro rider, and I can't get off the snow. And we had just the most epic preseason this year. Just got hammered. This is the first warm up we had, but it's going to be short lived.
No, I know that. We have some assets up in Syracuse, and the guys were telling me that all the snow that came off the lake there, and it was kind of early this year.
Yeah. Now, let me ask you, with all the institutional investors you work with, the family offices, is there something that they're leaning toward right now? Like, what is the appetite of the hour, if you can answer that?
Well, one thing is if you're a big institution like a BlackRock, start with one of these gazillion-dollar funds, for you're looking at very large transactions, because it's the same brain damage for a $10 million investment as it is for a $100 million transaction. And when you're sitting on $15 billion in your fund and commitment, you want to get it out the door so you can make your asset management fees. And Blackstone recently exited some assets because I watched what these things sell for, and they didn't make any money on them. But they had to buy these large pools, and sometimes you win and sometimes you lose. Unfortunately, capitalization rates are up, interest rates are up. So what they felt there was a time to sell and redeploy the capital. Some of the family offices that we work with, it's the first rule is don't lose money. There are no other rules. They're all the same. And so for them, it's finding something with cash flow with appreciation They can hold for many years. We have one family office in one of our properties in Nashville, and they want to buy out all the other investors. And I'm like, fine, you want to approach them all? That's fine. I said, we're in no hurry to sell. We love the asset. And so they want to buy it. And for them, it's also about a perpetual hold because they want the cash flow. So they don't really care about, being in 3 to 5 years. Your families are very patient, where institutional investors don't have that patience. So those guys want to know they could be out in 3 to 5 years because that's what their IRR, their promote is based on, being able to churn the money. I'm very happy to sit there as long as investors want to sit there. We, as most people, we underwrite for a 5-year hold, but it comes to year 4, we start talking to the investors, and they're like, what are we going to do with the money? Let's just refinance and continue to hold, which is fine for me. It dilutes the promote, but I don't really care because for me, I enjoy the cash flow. Yeah. So that's why I like to think that my interests are pretty well aligned with anybody. And we've had investors that needed to get out early, and the investments are attractive enough where we're willing to buy you out if you need to get out. But in a lot of cases, we've had other investors that wanted a bigger piece of the deal.
Interesting. Let me kind of transition a bit. I had a gentleman in, this is kind of why it's top of mind, and he's a large storage developer. They build ground up, and they build big units, like 1,000+ storage units. What's your take on storage right now?
I find it fascinating. It sells on low cap rates when it's done. But, I've always thought about, when these things you don't pay, and you have that show Storage Wars. I've always been a fan of, it entices me. Maybe I go buy a storage locker. I want to go see how this works. Maybe I can find a safe with, Al Capone's vault in it or something. And actually, there was one in New Jersey here where the locker was sold and there was a safe in it had a couple $1 million in it.
Wow.
It belonged to one of these families. And so there was a deal that they got most of their money back. So you find all sorts of stuff in these lockers. Collectible items, illegal items, some household goods that you can use, and then sometimes a lot of crap. I think that in certain neighborhoods where there are big transitions of people getting out of larger homes, going to smaller homes, they need a place to put the stuff. But then you also have to, how long are you going to store stuff? You got to pay it every month. So I think there's a need in certain neighborhoods, but in some neighborhoods, then these things can get overbuilt. That's what I see. I like it as an investment class because it's also boring, but it's almost more, you have to herd more cats to collect your rent. It's worse than multifamily because the checks are a lot smaller and you have 3 times as many tenants. So again, I don't know what's involved in the operation. I don't know how fast they lease up. I don't know how you keep it full. I think you keep it full just by people having their credit cards on file for automatic payment. Because a lot of times, how many times do you scrutinize what's on your credit card bill, and you're like, yeah, I'll cancel that next month. I'll cancel it next month. We'll do that. And people say, oh yeah, it's a storage locker. Oh yeah, it's a storage locker. I haven't been there in 10 years to get my stuff out of there, but yeah, it's my stuff. I got to pay for it.
Yeah, it's interesting. I've never invested in storage, and every time I talk to them, it's intriguing because it is a boring investment, very low overhead to operate because he's saying like they got one unit. I think it's 300 lockers and they have one employee, one person. And that person literally just sweeps things out when they're emptied. Right. So from an overhead standpoint, it's good, but it is, and he even said that word. He said, it's just very boring. He said, there's nothing sexy about storage outside of it makes good money. And that's it. So with that, let me ask you this. Everything you're seeing in the economy and the market, what do you think 2026 holds for us? What do you think should happen?
I think 26 is going to be a good year for industrial, for shallow bay. You have all this AI money getting invested to build data centers. And in a lot of cases, they're displacing tenants to build larger facilities, and those tenants need to go somewhere. One thing that I'm looking for is buildings that have lots of existing power that's being used, because at some point in time, if I have 15 or 20 megawatts that's there, someone's going to pay me for the power because they need to move it down the grid for a data center that needs 50 megawatts to operate. And so that's one thing that we've started really paying attention to, especially if I could buy the building at a huge discount to replacement cost and it comes with the electric that's in use. So I know that I can just sell the electric and double my money at some point.
That's you're the only person I've ever heard mention that, because data centers, like that's the new rage, right? Like they're happening everywhere. So massive opportunity there, but I never heard anybody talk about the energy component.
Well, that's what holding back. It's like for years, we've as a country haven't really invested in infrastructure, not just bridges and roads and tunnels, but electrical grids. You look at like Dallas, when the cold west snap comes through there, all the grid shuts down and people freeze because A, the homes aren't properly insulated like we have in the Northeast, and B, the electrical grid can't feed all those electric heaters because they don't have gas or forced hot air or baseboard or anything like that. Where China has been investing the last 5 years in building power plants. So as the power is needed, you have to either order gas turbines, and there's a 2 or 3 year wait right now for those. I've been to a few data center conferences. I just want to hear what's going on. Or you got to use a self-contained nuclear plant, and you got to get online for one of those. But the one thing that is kind of interesting is what's the life of a computer chip? I looked at one offering memorandum where they say that they replace chips every 10 years. That technology changes every year or every 2 years. So don't tell me you're going to change the chips every 10 years. You're going to have a dated data center.
NVIDIA would be out of business if that were the case.
Yeah, that's right. NVIDIA would be out of business. All those chip manufacturers would be out of business if your chips are going to be up for 10 years. But I think that it's just like engineering a model for apartments. If you said to them, you got to change the chips for every 2 years, people want them, then there's no cash flow. You're in the hole all the time. But the cost to build these data centers and then what people pay for them. Who buys a deal on a 4 cap? I buy treasuries where I have no risk.
Yeah, exactly.
Before I buy a data center. There's an article that came out in one of the trade journals that talked about how OpenAI, they needed to raise like $200 billion to build the data centers. So you got to raise all this money, and then you have all this commercial paper that's out there, and who's backstopping that? How valuable is it? You're going to buy that, junk bonds at some point in time when these companies can't actually generate income. But right now, everything is on an upswing. And if you go back and you look at something like Moore's Law, every 10 years, software catches up with hardware. So, you need less space. Anytime you're building these, million+ square foot buildings that are all this electric, and as the technology continues to evolve, you don't need that space anymore. So then what happens? That's why I like these, 100,000 square foot buildings with 15 megawatts of power on 2 feet. I got the fiber in the street. They're perfect for what's called an enterprise user, like a cloud, if the tenants don't need them. That, and as we onshore manufacturing, that's one thing prospective tenants are going to need is power. They're not going to rent the building to open a factory. I don't care whether you're building widgets or bicycles or whatever it is, you need electric. So if you already have the electric, your building should be able to lease faster than the guy down the road that doesn't have any electric or very little.
Interesting take. Very interesting. And I remember the prior administration, love them or hate them, doesn't really matter, where they were really pushing this whole EV model, and everything going electric. And, I live in New York, and it sounds like you know a lot about New York as well, where Hochul's, forcing gas stoves out. Right now, everything is heat pumps and electric stoves. It's just like you just mentioned about the grid in the infrastructure for that. It's just not there. So how do you support all this usage of electric when, we're working on an infrastructure that's just prehistoric, if you want to put it that way? It just can't support
it. Makes no sense because the grid isn't there. The beautiful thing is, like, I lose electric, I got gas, I can cook, I got heat. It's not like it's all right, I have a generator. So
who the hell likes to cook on an electric stove? I mean, let's get real. I mean, it's like the worst possible thing you can cook on.
No, it is, because you can't tell if it's hot when it's off. Although I'm fascinated by these induction cooktops because it only generates heat when the pot is sitting on it. When you take it off, it's cool to the touch. That's what I find is really interesting. But other than that, Hurricane Sandy came through here. Everything was underwater. I'd have an electric oven because it's better for baking. So I couldn't bake, but I had the cooktop, the stove. I could boil water. I could do whatever I want. I had the barbecue, which is on the natural gas in the backyard. I could bake pizzas in there. I could use the smoker. I could use the Blackstone as gas. I could do it all in the backyard. I didn't really care. But I think that to make everybody go all electric, the only thing I could think of is people think it's safer. You don't have to worry about a gas leak or an explosion that could happen with a gas leak. That's the only thing I could think of.
Gas leaks and explosions, like they're so far and few. I mean, like you probably count them on one hand, like the ones that you.
I agree with you. I agree. I just don't know what it's about.
Interesting.
Don't know.
So with what you do, you mostly work with the family offices in this. I mean, like, what about the average investor? Like, do you ever work with them?
Yes, we do. We do. We for many years it was always like friends and family only, and then like 3 years ago we opened it up to the general public, and we've done marketing over the years. I've done marketing. I think I've been on 30 or 40 podcasts. I've spoken at conferences, and we do a 506 raise, and although I'm not looking for investors to write a check for $25,000 or $50,000, we're looking for stuff that's a little bigger, because I find that the smaller investors aren't really sophisticated enough. They ask, first of all, if you've done apartments before, they try to underwrite this like an apartment. It's not the same animal. And I find that they need less handholding. So we do have a lot of accredited investors that write checks, 100,000, 200, 400, 500, and then we got the family offices with the big dollars. And it's really been a blessing, because sometimes the institutions only want to write mega checks. We've done deals with institutions to put up 90% of the money, but for them, if they can't invest 25 or $30 million at a clip, then they don't really have an interest. So people are very grateful that we're opening up to them, and every deal, 3 or 4 more people show up because their friend had invested in us with 2 or 3 transactions, and they like the cash flow. That, and the way I like to do the investments is I like to do the investor management. So because I'm involved with the acquisition and the underwriting and the asset management, we sort of have a cradle to grave mentality where everybody is sort of stirring the soup at the same time. You can actually talk to somebody that knows what's going on at the property real time. Where I decided I wanted to see what one of these syndicators was doing with some apartment deals. I noticed they owned them already because I looked up that they owned them already. So you could look, I have all these services. And I was curious why they're raising capital for it. So I make an appointment. I get on the phone with the young investor relations guy. And I said, I understand you got a lot of deals that aren't performing and others that are on watch list. He goes, yeah, it's, what happens in the business. And I said, what has all this taught you with the cycle of expenses fluctuating, and maybe you need to leave more room in your underwriting. And he said, well, we've learned that we need to always have container loads of kitchens and bathrooms and flooring so we can renovate faster. Not that we should take less leverage, not that we should assume that operating expenses could increase 3 or 4 or 5% in a year, or that rent growth, might not happen so fast, so we're going to renovate slower. Nothing about that. It's all about having the materials on hand.
So let's say an investor's got $100,000 to $500,000. They want to go into something to diversify a little bit. What would a deal with you look like? Like, just kind of give me just like a roadmap of what that would look like.
Sure. We look for investments that can typically distribute, 8% in the first year after closing. So they might have a light value add where I'm doing some lease up, or maybe I'm building an extension on a building, or maybe I have a lot of excess land that I can create trailer parking on, or things like that. But I'm looking for sticky tenants that I know are going to be there, and I'm going to continue to move the rents 3 to 4% a year. And so as we move the rents, because they're largely triple net leases, your distributions will go up. And so they're boring investments. You get a monthly financial statement. And the first time I started sending them out, people said, "What the hell did you send me? It's 8 megabytes." I said, "It's a monthly financial statement." But we have never seen any of these before. We don't get this on our other investments. Do we need this? I said, "Yeah. You got an income statement, a balance sheet, the general ledger, accounts receivable, accounts payable, a rent roll, and copies of the bank statements." They're like, "That's a lot of data." Well, that's what a monthly report, what do we need to read? I said, read the 2-page summary or read the body of the email. If there's something I think you should know, it's going to be out in front of you and hit you on the head. If it says we're 100% leased and we have no pending expirations and everything, so just file it away. I don't want you to ever come back to me and say, I never gave you a financial report.
That is rare though. I mean, like sometimes you get P&Ls, but that's about it. You're giving bank statements.
Yeah, well, P&L is one thing, but I want to see the balance sheet. How do I know you don't have some debt somewhere that you're putting extra debt on it?
Liabilities,
you're not paying liabilities. You're not paying the vendors. How do I know that?
Good point. Very good point.
How do I know you're not stealing the cash? If it's crazy.
And what's the average duration of your deals? So someone puts money in, like how long are they in the deal?
We typically, as I said earlier, we underwrite for 5 years. We've sold deals as early as 18 months, and we've owned stuff 30 years plus. We always find a way when there is a refinance. If you want to get out, you get out. If you need to get out early for some personal emergency, we'll help facilitate that for you to get you your money out on the deal. But then again, once you're getting 10% a year current, do you really want to sell it? You'd probably say to me, let's not sell, let's just refinance, and then I'll invest something else.
Yeah.
What we've also done in the last 2 years is a lot of people have come to me with 1031 exchanges. Then I don't want to buy a Walgreens. I don't want to go in a DST because I can't benefit from a cash out refinance in a DST. They can't do that. A Delaware statutory trust where a TIC can, and we've had deals with 8 or 9 ticks in them sometimes. And we although it's a tick for tax purposes, when we distribute money, you get just like your regular LP. It's based on pro rata ownership. If there's a refinance, you get a share of the proceeds, the cash out based on your that. But the beauty of that is, if when we do sell, you can either exchange with other people like us, or you can go your own way and you can keep managing tax consequences. So I've noticed a lot of guys that have come to me that are selling pools of single family homes that they bought because they're finding this in certain markets, they're getting crushed. So we benefit of a lot of those guys in the last couple of years, and we have a multi-tick structure. And you treat it like family. It's a family business. So this is all relationships. It's not like Wall Street where it's all impersonal and it's a black box.
I like that. I know for a fact there's a lot of people that are going to listen to this episode that are definitely going to be interested. So what we'll do is we'll put your info up in the description here so people can reach out to you, because I know a lot of people have gone after those big returns, gotten burned, and just looking for that steady Eddie, boring. I just want the cash flow again. Like I just want the check to show up. And that's exactly what you've said this entire episode as we've kind of gone down this. So I appreciate you doing it. I appreciate you sticking to kind of that one boring asset and coming on and talking about it. Is there anything that you want to tell the audience before we kind of wrap this thing up?
I think that you should be afraid of any deal of what you don't know or what you can't foresee. And that's why, if you're going to invest with somebody, really make sure they have their own money in the deal. These syndicators that operate funds really may tell you they have, $10 invested in the fund. But by and large, they have the real money. And then anybody that needs to do deals to generate fees to keep their lights on, don't go anywhere near them. When interest rates are moving and operating expenses are moving, I think it was 18 months we did nothing. We have enough. We manage our properties. We have enough property management, asset management fees, and some third-party consulting we do for other investors where we were fine. We're not doing a deal just to make fees. We're doing a deal because we like the deal.
That's important. And I love that you mentioned having your own money in the deal. I mean, that just lends to the credibility of the deal. If somebody doesn't have money in a deal that they're promoting, run away, because it's just, there's a reason. And I appreciate it. I love everything you said. So again, folks, if you're listening, we'll put that up in the description so you can get a hold of them. You can talk to them about their deals. Did you always have deals going, or is it just,
we always have. No, we always have a deal that I'm looking at, because even now I'm playing with a deal that's been out on the market for a long period of time. And then it's also a question of, how bad do I want the deal? Like, I'm never going to be the guy that pays the most for the deal. I'm going to wait like a hailstorm in Dallas, and you're going to buy a car. When it's dinged up a little bit, you're falling out of contract once or twice, and you're more flexible on the price. I'm the guy you call. So we always have a deal. It's a question also on if someone came to me and half the equity is coming from a 1031 exchange, I'll move a deal faster because I know that I have half the equity is raised and it helps me progress it a little bit faster.
Love it. Love it. Well, I really appreciate you coming on. Thanks for all the advice. And folks, I know you've enjoyed this. It's different. It's boring, but it's exactly what all of you needed to hear. Irwin, thank you so much. And for all of you listening, thanks for joining us here at the Money School Elite. We will see you on the next episode.